Two guys buy the same Bitcoin. Same day, same price. Years later, it's up 10 times. One cashes out and keeps every dollar. The other hands almost a third to the IRS. Same coin, same gains, same country. So what did the first guy know that the second one didn't? Honestly, it comes down to one boring little detail nobody talks about: where he kept it. Look, Bitcoin's down about 11% this year, and that's usually right when the smart money makes its move. Not on the coin itself, on the account it lives in. Here's the thing: most Americans keep their Bitcoin in the worst possible spot when it comes to taxes, and they have no clue they're doing it. You might be doing it right now. And there's a rule change rolling out in 2026 that's about to crack this wide open for your 401k. That part's coming, so stick around for Chapter 8. But first, let me show you the move itself, the one that turns a taxable headache into completely tax-free growth. So grab a coffee. Trust me, this one's worth it. By the end of this video, you'll know exactly how to hold Bitcoin so the gains can come out completely tax-free, where to put it, how much, and the mistakes that quietly cost people thousands. Real quick, if we haven't met, I'm Sam. I break down taxes, investing, and retirement in plain English, so you keep more of what you earn. No Wall Street jargon, no hype. So here's the plan. First, why your regular account is silently taxing your Bitcoin. Second, the account that fixes it. Third, the big one: Roth versus traditional and which one actually wins. Then we'll settle the ETF versus actual coin debate, figure out how much Bitcoin you should really hold, and break down that 2026 401k change I teased a minute ago. And I'm not going to pretend Bitcoin is some magic money printer. We'll talk about the real risks too, the stuff most crypto channels skip right over. Now, the disclaimer: this is not financial advice. Always do your own research, and look, Bitcoin can swing hard and lose value fast, so never bet money you can't afford to lose. Cool? Cool. All right. To see why the right account matters so much, we first have to look at what the IRS does to your Bitcoin in a normal account. Honestly, it's worse than you think. So here's what most people don't realize: the IRS doesn't see your Bitcoin as money. It sees it as property, like a house or a share of stock. And property comes with a tax bill. Every single time you sell Bitcoin or even swap it for another coin, that counts as a taxable event. You sold, you gained, you owe, even if you never touched actual cash. Now here's where it stings. If you held that Bitcoin for a year or less, your gain gets taxed just like your paycheck, ordinary income. That can run all the way up to 37%. Let that sink in. 37%. You took all the risk, you sat through the stomach-churning drops, and Uncle Sam can still walk away with more than a third of your win. Hold it longer than a year, and it's better. You drop into long-term capital gains rates. But make no mistake, that's still a real chunk of your money leaving the building. And don't think about just forgetting to mention it. When you use an ETF, your broker files a Form 1099 with the IRS. They already have the numbers. They're just checking your math. So if your Bitcoin is sitting in a regular account right now, picture this. Every dollar it grows has a little tax tag stapled to it, just waiting. That's the default, and almost nobody questions it. But what if I told you there's a perfectly legal account where those gains can grow and come out without the IRS touching a penny? That's next. Don't you dare click away. Okay, the account that changes everything, it's not some offshore secret. It's a retirement account, an IRA, the same boring thing your parents have. Turns out it might be the smartest place on earth to hold Bitcoin. Now, I know what you're thinking. Wait, you can actually put Bitcoin in an IRA? For years, you really couldn't, not easily. But that quietly changed back in early 2024. Here's what happened. Spot Bitcoin ETFs hit the market. In plain English, that's a fund that holds real Bitcoin for you, and you can buy it inside a normal brokerage IRA with fees as low as 0.2%. And this is the part that matters. Inside that retirement account, when the price runs up and you buy or sell, there's no tax bill on every move. No stamp, no slice, no little tax tags. So, if you just joined us, here's the entire video in one sentence. Hold your Bitcoin inside the right retirement account, and you can stop feeding the IRS on every gain. That's the move. And there's one version of this account, the Roth, where it gets even better. The money doesn't just grow without tax, it can come out years later completely tax-free. That's the green jar. And look, this isn't some fringe idea. Since these ETFs launched, somewhere around $96 billion has poured in. The big players already figured this out. Most regular folks just haven't heard yet. But before you go open an account, pump the brakes because there are two flavors of IRA, and picking the wrong one can cost you a fortune down the road. Let's settle it. So you're at the fork. On one side, the red vault. That's the traditional IRA. On the other, the green jar, the Roth. They both hold Bitcoin, but how they handle the tax man could not be more different. The red vault gives you a gift up front. You put money in before taxes, so you shrank this year's tax bill. Feels great. But here's the catch. The tax man didn't leave. He's just waiting at the exit. With that traditional account, every dollar you pull out in retirement gets taxed like income. And once you hit 73, the government forces you to start withdrawing, whether you want to or not. Now, the green jar, the Roth. There's no tax break today. You fund it with money you've already paid tax on, but then the door locks behind it. It grows and it comes out tax-free. And this is why the Roth and Bitcoin are such a perfect match. Think about it. Would you rather pay tax on a single acorn or on the whole forest it grows into? Tax the seed, not the harvest. One quick catch so you don't trip on it. To get that money out totally tax-free, you generally need to be at least 59 and a half, and the account has to be open 5 years. Plan around it. Now, is the Roth always the answer? Not quite. If you're a high earner today and you expect a much lower tax bracket in retirement, the red vault can actually come out ahead. It depends on your situation. Okay, so you've picked your account, but hold on. How you actually own the Bitcoin inside it, the ETF or the real coin, changes the game too. And most people get this part wrong, right after this. So inside your IRA, you've got two ways to own Bitcoin. Door number one, the ETF. Door number two, the actual coin. They sound similar. They are not. And the difference comes down to one word: control. Door 1, the ETF, is the easy button. You buy it right inside your normal brokerage account. Fidelity, Schwab, wherever you already are. They hold the Bitcoin for you, and the fee is tiny, around 0.25%. The trade-off: you don't actually hold the coin. You own shares of a fund that holds it, and you can only buy and sell while the stock market's open. Bitcoin never sleeps, but your ETF does. Door number two is the self-directed IRA. This one lets you hold the real, actual Bitcoin. Your coins, your keys, total control. For a lot of crypto folks, that's the whole point of Bitcoin in the first place. But that control comes at a price. You need a special custodian, the fees are usually higher, and the setup is a lot more work. Plus, the security is on you. Lose your keys and that money's just gone. You'll hear crypto diehards say it: not your keys, not your coins. And honestly, in the wider crypto world, they've got a point. But inside a retirement account, you're not trading every day, you're parking it for the long haul. So here's my honest take. If you just want clean, simple Bitcoin exposure in your retirement account, the ETF wins for most people. If you're a true believer who wants to hold the real thing, the self-directed route is there. All right, you've got the account, you've picked Roth or traditional, and you know how to own it, which leaves the big question everyone's actually been asking this whole time. How much Bitcoin should you really hold? All right, the big one. How much Bitcoin should you hold? And the honest answer is probably way less than the internet is screaming at you. Because with Bitcoin, the size of your bet is everything. Before a single dollar goes into Bitcoin, get the free stuff first. Grab your full employer 401k match. Build a real emergency fund. Knock out any high interest debt. Bitcoin is dessert, not dinner. Once that foundation's solid, Most advisors land somewhere between 1 and 10% of your portfolio. Sounds tiny, I know, but even a small slice of something that can really run adds up fast. And honestly, the IRA keeps you disciplined. For 2026, you can only put in $7,500 a year, a bit more, around $8,600 if you're 50 or up. You can't go overboard even if you tried. And don't dump it all in on a Tuesday afternoon because you got excited. Drip it in, a little every month. That way, you're not betting everything on one price on one day. Boring works. Here's the real test. Picture your Bitcoin dropping by, say, 70%, because it has before. If that wrecks your retirement, you've got too much. If you can shrug it off, you sized it right. So if you just got here, here's the whole game plan. Cover the basics first, keep Bitcoin a small slice, drip it in over time. Do that, and you're already ahead of most people gambling on this stuff. Now, remember that 2026 rule change I keep teasing? The one about your 401k? It's finally time. And it might just blow this whole thing wide open. Don't go anywhere. Okay, here it is. The thing I've been teasing since the start. For years, your 401k, the big retirement account through your job, was basically a locked door when it came to Bitcoin. That's now changing. Back in 2022, the government basically waved the giant caution flag. It told employers to use, and I quote, extreme care before letting anyone touch crypto in a workplace plan. Translation: don't. Then things shifted. In 2025, regulators pulled that warning back. They stopped wagging the finger and went neutral. Suddenly, crypto in a 401k wasn't this forbidden thing anymore. The mood completely flipped. It went further. An executive order came down telling regulators to actually clear the path for alternative assets, Bitcoin included, inside workplace retirement plans. The door wasn't just unlocked, someone was pushing it open. And then, in early 2026, the Labor Department proposed a brand new framework. Basically, a set of guardrails for employers who want to safely offer this stuff. Things like checking fees, risk, and how easy it is to sell. Now, pump the brakes with me for a second because this is the part the hype videos skip. That framework, it's a proposal, not a law yet. These rules can still shift before anything's final. And even if it all goes through, there's a catch. Your employer still has to actually choose to put Bitcoin on your 401k menu. And right now, most of them haven't, so don't go refreshing your account just yet. So here's the real takeaway. The 401k door is creaking open, slowly. But the IRA, that one's wide open today. You can walk through it right now. Which brings us to the stuff nobody likes to talk about, the risks. Okay, this is the chapter that actually keeps you out of trouble. So if you skip everything else, don't skip this. Because Bitcoin can and absolutely will put you through the ringer. Let's be real about the roller coaster. Bitcoin has crashed more than 70% before. Not once, multiple times. In 2022, it fell from around 69,000 to 16. If that would gut you, you're in too deep. Mistake number one, putting money in here that you'll actually need soon. Remember, this is a retirement account. It's locked up till you're nearly 60. Your rent money, your emergency fund, that does not belong in Bitcoin. Mistake number two, and it's the big one, going too heavy. We said it earlier and it bears repeating. If a brutal drop would torch your retirement, you bought too much. Small slice. Always. Mistake number three is letting your emotions drive. People pile in when it's mooning and panic sell when it's bleeding. That's how you buy high and sell low, every single time. Your boring drip plan? It fixes this. Mistake number four is sneaky. Inside that IRA, the tax shelter cuts both ways. If Bitcoin drops, you can't use that loss to lower your taxes like you could in a regular account. The shield works in good times and bad. Two things to keep on your radar. There's a proposed rule that could change how crypto losses work in regular accounts. Not final, so just watch it. And Bitcoin isn't insured like a bank deposit. No safety net. Look, none of this is meant to scare you off. It's meant to keep you smart. Dodge these traps and you're already ahead of almost everyone. So let's bring it home. Your exact move step by step, right after this. All right, we covered a lot, so let me hand you the whole thing as one clean game plan you can actually run this week. No notes needed, just follow the steps. Step 1, cover your basics. Full employer match, emergency fund, high interest deck gone. Step 2, open a Roth IRA so your Bitcoin gains can grow and come out completely tax free. That's your green jar. Step 3, for most of you, buy a spot Bitcoin ETF right inside that account. Step 4, keep it a small slice, 1 to 10%, and drip it in a little at a time. That's it. That's the move. And remember those two guys from the start? Same coin, same gains. The difference was never luck. One of them just held it in the green jar and kept every single dollar. Because that's what this channel is really about, not getting rich quick. Keeping more of what you already earn and building your own way out, one smart account at a time. Now, I want to hear from you. Drop your state in the comments and tell me your Bitcoin allocation. 0, 5%, 10? I'll tell you straight up if it looks reasonable. If this finally made Bitcoin in retirement click, hit subscribe. We do this every week. Watch the video right there next. It pairs perfectly with this one. And as always, not financial advice. Do your own research. See you in the next one.